What if I told you there's an Indian auto parts company that just wiped out over 2,000 crore rupees of debt in a single year, grew its profits by 41%, and is now quietly pivoting into aerospace? Stick around, because today we are breaking down BELRISE Industries' FY26 earnings, and trust me, the numbers are wild. Let's get into it. Okay, here's the big picture. 3 headline numbers, and all 3 are impressive. Number 1, revenue. BELRISE clocked 9,509.1 crore rupees in FY26. That's a 14.7% jump year over year. The driver? Multi-year structural turnarounds in the four-wheeler and commercial vehicle segments. Number 2, profit. Adjusted PAT, that's profit after tax, came in at 502 crore rupees, up a massive 41.2% year over year. How? Because lower debt servicing directly amplified the bottom line. Less interest paid out means more money flowing to shareholders. And number 3, the headliner, the big deleveraging. BELRISE erased more than 2,150 crore rupees of net debt in FY26. That one number radically reshaped the company's leverage comfort and capitalization ratios. So revenue up, profits up big, debt down massive? That's a constructive stance indeed.
Let's expand on those 3 numbers, because each one tells a story. Revenue at 9,509 crore, plus 14.7%, driven by a strong volume push across four-wheeler and commercial vehicle sectors. EBITDA, basically the core operating profit, came in at 1,153.8 crore rupees, up 13% year over year. Now notice, revenue grew at 14.7%, but EBITDA only grew at 13%. That tells you margins compressed slightly. We'll diagnose exactly why in the next slide. And then adjusted PAT at 502 crore, plus 41.2%. This explosive bottom-line growth was driven by 2 things working together: operational scaling combined with massive financial deleveraging. The company is firing on multiple cylinders simultaneously.
Now, the full-year FY26 EBITDA margin was 12.13%, down 19 basis points year over year. And in Q4 specifically, the margin dropped to 11.4%, which is down 70 basis points compared to Q4 of the previous year. If you look at the quarterly chart comparing FY25 and FY26 margins side by side, FY25 held fairly steady around 13.8 to 14% all year long. FY26 started similarly, but drifted downward through the year, with Q4 seeing the sharpest drop. So what caused this? 3 things. First, labor and OPEX pressure. Regional minimum wage hikes combined with one-off integration expenses hit the cost structure hard. Second, subsidiary drag. The newly acquired aerospace unit, called SDM France, reported a temporary startup and machinery overhaul loss of 9.47 crore rupees. That's a drag from a brand new business unit still being set up. Third, and this is the key forward-looking point, management expects the aerospace unit to reverse to profitability by FY27. So this margin pain is largely transitional, not structural.
This is arguably the most important part in the entire video. Let me paint the picture clearly. At the start of FY25, BELRISE was carrying 2,750.7 crore rupees of net debt. By the end of FY26, that number had fallen to just 597.7 crore rupees. That is a reduction of over 2,150 crore rupees, achieved through aggressive repayments and balance sheet restructuring. The impact on leverage ratios is extraordinary. The net debt to equity ratio plummeted from 1.01 times, which is fairly high, down to just 0.11 times. That is an elite-level metric for any manufacturing company, especially in India. It means for every 100 rupees of equity, the company owes only 11 rupees in net debt. And on top of that,
cash and equivalents expanded massively. BELRISE now sits on a liquidity cushion of 841.3 crore rupees. This company has gone from leveraged to virtually debt-free in a single year. That is remarkable capital discipline.
Now, here's a question sophisticated investors always ask. Are these profits real, or are they inflated by accounting tricks? This is answered right here. BELRISE's net profit, or PAT, was 496.9 crore rupees. But here's what matters. Operating cash flow, or CFO, was 875.6 crore rupees. Free cash flow, after capital expenditure, was 389.5 crore rupees, still strongly positive. The CFO to PAT ratio is 1.76 times. What does that mean in plain English? For every 1 rupee of profit the company reports, it is actually generating 1 rupee and 76 paise in real cash. Cash is outrunning profit. That is the gold standard of earnings quality. There's minimal reliance on non-cash adjustments. The transaction flows are authentic. This is not a company manufacturing profits on paper. The cash register is genuinely ringing.
Let's talk about where the revenue is actually coming from and why the mix is changing in a very interesting way. The revenue breakdown currently looks like this. Two-wheelers and three-wheelers dominate at 83.2% of the total mix. Four-wheeler commercial vehicles account for 8.4%, and four-wheeler passenger vehicles make up 6.2%. Now, two-wheeler and three-wheeler grew at 18.1% year over year, which is solid. Content per vehicle expanded by up to 65% through new proprietary systems, meaning BELRISE is selling more value per vehicle, not just more vehicles. Four-wheeler commercial grew 32.1% through long member frame applications. But the real story, the hyper-growth engine, is four-wheeler passenger vehicles, which exploded by 171% year over year. That growth was driven by the structural absorption of high-tensile parts from the H1 platform. Even though it's only 6.2% of the mix today, at a 171% growth rate, this segment is going to reshape the revenue composition very quickly.
And here's where the story gets really exciting for long-term investors. BELRISE is not just an auto parts company anymore. They're executing 2 parallel future-proofing strategies simultaneously. On the left, the green vehicle strategy. 73.8% of manufacturing revenue is now powertrain agnostic. That means it doesn't matter whether a vehicle runs on petrol, diesel, CNG, or electricity. BELRISE's structural frames and plastics work across all of them. By focusing heavily on structural components rather than engine-specific parts, the company is deliberately decoupling itself from traditional internal combustion engine exposure. This is smart, forward-thinking positioning ahead of India's EV transition. On the right, the global Tier 0.5 ambition. BELRISE is making an aggressive push into aerospace and defense engineering. Their smart acquisition, Chester Hall UK, bought for £13.2 million at approximately 6 times EV to EBITDA, is a particularly efficient deal. This acquisition gives them immediate supply line access to global primary aerospace engine networks.
Let's quickly check the operational efficiency dials. Return on capital employed, or ROCE, is at 14.7%, optimized upwards by 20 basis points. This signals high asset efficiency following the post-IPO recapitalizations. It means the company is generating strong returns on every rupee of capital deployed in the business. The current ratio, a measure of short-term liquidity, stands at 1.97 times, a massive improvement from 1.34 times in FY25. This jump happened due to a sharp drop in near-term borrowing maturities. Practically speaking, the company is in a much more comfortable short-term financial position. And finally, working capital, showing a linear build of plus 19.4%. Inventory and receivables scaled perfectly to fund the commissioning of new facilities entirely through operating cash flow. No additional borrowing needed. All 3 efficiency dials are pointing in the right direction.
Here's the part that separates serious analysts from casual observers. A forensic accounting checklist,
and BELRISE passes all 4 tests with clean green checkmarks. Test 1. PAT versus CFO misalignment. Cash generation is tracking significantly ahead of stated profit, as we saw with the 1.76 times ratio. Test 2. One-off manipulation. Exceptional items are minor and transparent. Nothing suspicious being buried in the numbers. Test 3. Unexplained inventory spikes. Trailing inventory changes are fully synchronized with commissioning lines. The inventory build makes complete operational sense. Test 4. Aggressive unbacked capex. Free cash flow remains highly positive at plus 389.5 crore rupees even after funding all internal allocations. 4 for 4. Clean bill of health. The accounting quality here is genuinely high.
Now let's talk valuation and what's happening on the corporate action front. There's a striking valuation gap visible here. Promoter-owned units are being consolidated at approximately 8.3 times price to earnings, a heavily discounted multiple compared to the public entity. The listed entity is trading at 30.9 times price to earnings on a run rate basis. Both are described as substantially below the public entity's peak multiple, meaning the market hasn't fully priced in the transformation yet. On the corporate action side, 3 important items. First, the structural integration of acquired units guarantees near-term EPS accretion. Earnings per share will go up as the integration's complete. Second, a final recommended dividend of 0.55 rupees per share has been announced. And third, the big one, management is aiming to raise up to 2,000 crore rupees through a qualified institutional placement, or QIP, to aggressively capture global aerospace supply chain shifts. That fundraise is the fuel for the next phase of growth.
So what's the bottom line? Here's the honest risk-reward assessment. On the positive side, first, elite structural deleveraging, with net debt to equity slashed to 0.11 times, giving the company extraordinary financial flexibility. Second, a substantial 65% expansion in content per vehicle through proprietary product entries, improving revenue per unit and competitive moat. Third, a clear and credible roadmap to becoming a global Tier 0.5 aerospace partner. On the risk side, first, high short-term customer concentration in traditional domestic two-wheeler metal fabrication. If that segment faces a cyclical downturn, near-term revenues get hit hard. Second, near-term margin drag and integration execution risk from international acquisitions, specifically SDM France. Cross-border manufacturing integrations are complex and execution risk is real. So the bull case is powerful, but eyes open on those 2 risks.
Here's where we stand today. BELRISE has successfully repaired its balance sheet. That chapter is closed. The immediate focus now shifts to the proposed 2,000 crore rupee QIP. If that capital raise executes well, it provides the runway to capture the incoming wave of global aerospace and defense supply chain relocations into India, which is a massive structural tailwind, given where global geopolitics and manufacturing diversification trends are heading. The transition from a domestic auto parts maker to a Tier 0.5 global aerospace supplier is actively underway. This is not a vision statement. They've already acquired Chester Hall, UK. They already have SDM France, and they're already on aerospace engine supply networks globally. The transformation is real. And if you found this BELRISE Industries earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.